Hello, good morning, everyone. Welcome to all of you for today's session. So, students, just let me know whether you people can hear me well. Yes. Can you hear me? You can respond in the chat box. You can open your mic and talk to me as well. All right, now. All right. So, if there is a problem for you people, those who are unable to hear me, yes, here is the way. Yeah. Now, so students, the point over here is we are here today for AFM, Advanced Financial Management, the subjects. And Advanced Financial Management is one of the most interesting subjects of ACCA. Just a minute, please. Some of the students are trying to join today. Just a minute, please. Let me help them. So as this is the first day today, number of students they are trying to join, and they are using it for the first time. So just a few minutes, please. They let them connect. Okay. Excuse me. Okay, students. So advanced financial management, this subject, we will talk about it in detail in a while. Just a minute. Let me connect my iPad with it. So that we can discuss things on a board. Yes, just a few minutes, please. Some students are on the way, and then I'll start my lecture, please. Thank you for your patience. Okay, students, now let us start with it. Students, I have opened the Excel sheet in front of you today itself. As you know, that your exam platform, to be familiar with that, that is very much important. And it is becoming a bit challenging for the student to tackle exam platform. Now, so that's why I have opened it from the day first, the Excel sheet, so you get used to of it. And I will take you to the exam platform as. So AFM, Advanced Financial Management. Yes. Advanced Financial Management, this subject. Student, this subject is very much important in this regard, in my opinion, and in the opinion of other tutors as well. Yes, can you hear me, Aisha, the student you joined? I told you today, the first day, they are using it for the first time. Yes, please. So please follow this guideline. Can you hear me, those who joined now? Tell me, please.
Yes, I can.
Okay, good. Now, so AFM, very well done. I prefer communication through mic. If you do that, it will give you a feeling that you are sitting in a classroom. More interactivity. It will enhance the interactivity. Now, so students, the AFM subject, if we talk about the subject has, what does examiner says? These are the words of your examiner. That the student must be able to demonstrate application of knowledge, skills. Not only this, but also exercise professional judgment in recommending, because you are going to be a finance manager. And being a finance manager means that you must have to make decisions as per the need of the business. You have to take decision. You have to advise. You have to give recommendation to the board of directors. So, and of course, remember, you are not doing financial management. Now you are in advanced financial management. Means a senior finance manager of the company who just don't have to see the calculation. I repeat my words. Who don't just have to see the calculation, but other aspects of the business as well. For example, impact on the reputation, ethical, environmental, and stakeholders' concern as well. So, yes, you don't have to see the calculation only. Calculation based, you have to extract meaningful conclusions from the calculation, supported by other relevant ethical, reputation, environmental issues. You have to, of course, consider that as well. And this is the reason, let me tell you why a student fail in AFM. This is the reason. They think that we have to just focus calculation and discuss that. And hence they are unable to pass the paper. AFM is something beyond that, means something above the calculation. Your level has been raised. Senior management of finance you are. Now, so students, sometime when you are going to make decision, remember there is not always one best decision available. There is not always one best decision available. Rather, you have to consider you have to consider multiple other aspects as well. For example, if I make decision A, what are the pros and cons of it? What if I take decision B? What are the pros and cons of it? Now, so that's why we have to consider both sides. So that's what they say. Now, some technical and ethical issues also which may be in conflict and not entire. This is what students don't understand when they are doing discursive part of the syllabus, the subject, when they're solving the question. They say it should be accepted. But what will be, yes, accepted, but what will happen? So candidates are required to display evaluative, analytical, judgmental skills when alternatives are being considered. You just can't see. Means that you have to think from the multiple aspect of the decision. Of course, presentation skills are important, logical, persuasive, sequential approach. They're important, of course. Now, so students, the subject should be clear cut that FP4 is an analytical subject. And what I was about to say when I got interrupted because of a student was unable to connect. So AFM, without AFM, I think ACCA is incomplete. I think. Why? Because the level of financing decisions you learn here, they are important. They distinguish you as a finance professional. Without AFM, you lack in that knowledge. So that's why whenever students ask me that which subjects should I do, so I normally recommend that if you are good in analytical skills, go for it. Now, so student, this subject, let us talk about this subject, this syllabus. Yes, syllabus. What is the syllabus of the AFM? We can categorize the syllabus into 4 parts. I'm saying 4 parts. The first part is Advanced Investment Appraisal. Yes. Investment Appraisal. This is the first part. And this first part, I must say, this is around 40% minimum of syllabus. Minimum 40%. I'm saying being precise. It may have more weightage and actually in the exam. Why I'm saying 40%? Because it takes this much time to cover. Now, of syllabus. Whatever you studied in F9, whatever you have studied, that is part of it. But advanced techniques as well. I will talk about it today. I will start this one area today. Plus weighted average cost of capital. That is also with enhanced variance. Then the second syllabus area, that is the mergers and acquisitions. Mergers and acquisitions. Again, this area has some connection, knowledge-based connection with it, investment appraisal. But some new topics as well, where we learn how to value a business. And what are the different aspects of acquisition, merger, legal aspect, how you can avoid merger, how you can, the defense against that. And then corporate, which I say, I normally corporate reconstruction consider part of the it. Corporate reconstruction. A small area, but very technical from exam point of view. A bit technical questions are tested here. Small area it is, that how you reconstruct, rebuild your organization. Your organization is drowning. It needs funds, already in losses. So what to do with that? How to reconstruct it? Different ways we will discuss. And the next is, that is risk management. The most interesting part of P4, in which you learned how foreign currency risks are managed, how interest rate risks are, different methods. And again, it is a big area, 30 to 40% of syllabus, but very interesting. Now, so these are 4 main areas, but I will add one more area, which I call theoretical part, which includes ethics, corporate governance, which is from your previous knowledge, broad forward knowledge. Plus, there are some other areas, some small topics, all right, like that, behavioral finance, behavioral finance, Islamic finance, and some other areas, plus a few more areas. And this is very much important. World Bank, role of IMF, European Union, etc., etc. Some which are basically which form financial environment for the finance manager who is operating international organization. He should have the knowledge of that. Now, so student, this is your syllabus. Now, the point is, so this theoretical area, students normally ignore. And if you pick any past paper, you will find 10 to 20 marks from it. And 10 to 20 marks, minimum 10 marks, they are very much important from exam point of view to pass a paper. Now, let us talk about that how they are tested. Remember, AFM is the subject where we have, like other optional paper, 3 questions: question 1, question 2, and question 3. Question 1 is 50 marks. It is 25 mark and 25 mark. Remember, any area can be tested anywhere. Yes. There is no, just like in P7 paper, I teach P7 in 100, and I tell there in question 1, this topic will be tested. Question 2, this topic will be tested. Here, no, there is no hard and fast rule. And all the question will be mix of the syllabus. Meaning in question 1, it will be mix of anywhere, from anywhere to more than one area is being tested. And you see the syllabus is quite clear cut. Now, let us proceed. How we will be proceeding with AFM? Just give me 1 minute, please. 1 minute, please. Actually, my iPad was not connecting with the laptop at that time. That's why I started typing. So how we will be proceeding and going through the syllabus? Students, we will start with the Advanced Investment Appraisal. Number 1. Then we will go to the risk management. And number 3, that is the mergers and acquisition. And corporate reconstruction with that. So this is how we will be proceeding through the syllabus. Which material we will be using. I will provide you the notes which will cover the whole syllabus in depth. Means you need not to read any book. That's enough. Plus, we will be doing exam kit BPP. And I will try to arrange a soft copy for you people. Yes, that will be arranged. Plus, any other past exam questions which I may give you additional, because a lot of practice is required. Now, so this is my approach. This is my approach. We will be solving one question. We'll be solving one, we will be discussing one topic with example and immediately followed by the relevant exam questions. Yes, any question you have, please. Anyone, any question? Yes, please. Is it clear?
Yes, clear.
Yeah, thank you. The response is very much important. Because in the online class, there is no way that I can read your facial expression, which normally in a room we can do. So chat box, yes or no, you have to help me by saying that. Okay, so will you help me by doing that in the chat box or the mic? I prefer mic. If you open the mic and say yes or you ask the question. Yes, will you be able to help me, please?
Yes, for sure.
Thank you. Thank you. Exactly. A very good question from Koshik. Remember, in P4, I need to spend minimum 60 hours with you people. A very good question. 60 hours. So if we conduct class, 3-hour class on Sunday only, we cannot conduct these 60. A very good question. Thank you, Koshik. I appreciate your question. Yes, we need to conduct additional classes, and they are most likely to be now weekdays, evening. For example, we can conduct that but we will decide that timing by mutual consensus in the WhatsApp group. Okay, most probably, let me tell you, if you agree, it will be at this time. It may be on Monday, Tuesday, most probably on yes, weekdays. And they will be conducted as from the end of August or start of September. One more thing, let me make it clear. Sometimes it happens that you miss a class. So this should be clear that we will be providing you the video recordings as well. You can watch after the class, revise the lecture. Yes, we'll be providing you. But remember, that should not be used as an excuse for missing the live class. Yeah. So is that clear? Anyone, any question, any problem? Please feel free to discuss. So are you okay with additional class?
Yes.
Because in order to do sufficient practice, we must have to do it. If I skip practice, I do some questions only, then of course we may not need any additional class, but practice is important. Now, so this was the introduction of the syllabus. Now we will be proceeding towards discussion of the syllabus. These are the table which will provide it to you. Now, let us start with the investment appraisal techniques. Yes. Investment appraisal techniques. Students, investment appraisal techniques. What is investment appraisal? That we are going to evaluate an investment, and this is the role of finance manager. That if business has to launch a project, they have to make a huge investment in a business, in a plant and machinery, in new factory. Since it is a huge drain of cash resources, so that investment should be evaluated first, that whether it will be beneficial for the business or not. So what are the ways to evaluate the investment? They are called investment appraisal techniques. So investment appraisal techniques we can classify into two types. One is called non-discounting techniques. Non-discounting techniques and discounting techniques. Two types of techniques are there. Discounting techniques are those techniques which basically where time value of money is incorporated, is considered. Time value of money. What is that? I will talk about that in a few minutes. And non-discounting techniques are those techniques in which time value of money is not considered. Time value of money is not considered. Now, next. That is accounting rate of return, ARR, payback period method. Payback period method. Here it is. discounted payback, NPV, IRR, duration, and MIRR. These are the investment appraisal techniques which are part of our syllabus. Now, one by one, we will be discussing these. Students, I am noting down here, and you people also will be preparing your class notes. Sometimes it may happen that I switch the page. I move to the next page and you have not noted down that. Feel free to ask me to go back to the previous page. Never hesitate. Now, so accounting rate of return, we will start with that. This is the only investment appraisal technique which is only profits based techniques. Only profits based. Actually, it is also called return on capital employed. You may have studied that. Rather, you have studied that in your earlier studies. ROS. So, how it is calculated? It is basically percentage return on investment. It is percentage return on investment. How it is calculated? ARR is equal to average annual profit, divided by average investment cross 100. In some formulas, you may find initial investment here. But examiner prefers this, average investment. And since it is more, that conceptually sound as well. Now, the next point is how to calculate average annual profit. How to calculate average annual profit. How to calculate total profit divided by number of years. And average investment is equal to initial investment plus scrap value divided by 2, average investment. Now, next. Students, how to solve that? I will be doing all the calculations. I'll prefer to do on the exam platform so that you get familiar from that from the day first. So I'll be opening that. ACCAglobal.com. I opened. Yes. AFM. Platform is here. Login. Blank workspace. It is already assigned. Just a minute, please. Yes, here it is. So, word processor and spreadsheet. I'll open the spreadsheet. Here we are. By the way, yes. Now, yes, now I think you can see it properly. So then, for example, so we are doing accounting rate of return. So for example, and we said it is profits based. A project which has the following profits. For example, these are the profits of the project, estimated profits. Initial investment is in the project is, for example, that is 1800, and scrap value, that is 150. Now we need to learn how to calculate ARR. So average annual profit equal to sum from here to here. Divide total profit divided by number of years. 4 years. There are 4 years. So average annual profit, we added 4-year profit divided by 4. Now, average investment initial investment plus scrap value divided by 2. Here it is. So ARR, accounting rate of return. Average annual profit divided by average investment multiplied by 100. We can do the percentage in another way. This is the answer. Average investment, average profit divided by average investment. And we can convert it into the percentage from here. I repeat, what we did. We calculated average annual profit, then average investment. Average profit, then average investment. Added both divided by 2. And then this divided by this, and then percentage. We could have done it in a shortcut instead of doing this calculation in this way. How? How you could have done it? Yes. Yes. Just see here. You can add this 4 here, calculate average. It means you apply the formula, direct formula. But if you think that you get confused, it's okay. It's good. Is it clear? What I have done, it is clear to you people. Tell me.
Yes.
All right. Now, thank you. Now, so the next point is, next. Student, the next point is, for another example, example 2. For example, you are given cash flows of the project. Cash flows. That is 850, 970, 750, and 1010. They say that initial investment is 2500. Sorry, 2500. Yes. And scrap value is 800. And they say calculate ARR, accounting rate of return. Now we are reviewing the data. We have to see the data very carefully. You see, we are not given profits. We are given cash flows. We need profits to calculate ARR. I told you ARR is profits based. Now, my question from you is, what is different between profit and cash flow? What is the difference? Tell me. Anyone? Anyone, please. What is the difference? Exactly. Exactly. You know that? Very well done. Profits include, rather exclude. When you calculate profit, you deduct non-cash expenses as well, and then reach at profit. So it means that if you want to reach cash flows, you have to add back non-cash expense to profit. Depreciation, which was deducted out of profit, you add back to the profit that, and then you reach the cash flow. So cash flow is equal to profit plus non-cash expense. So now we need profit. Then how to calculate? So cash flow minus non-cash expense, such as depreciation. Just rearrange this equation. Is it clear to everyone? This point is clear to everyone. Tell me. This relationship. All right, now, next. So students, we need to calculate profit. So what is non-cash expense here? Depreciation. And you will be thinking that depreciation information is not given here. It is given. How? They say initial investment in the project is 2,500. And then at the end, scrap value is this. Means initially you purchase asset is, and at the end value is this. Difference is depreciation. Now, so profits, total profits equal to, these are the cash flows. Cash flows minus non-cash expense. Applying this formula, profit is equal to cash flows minus the total profits. Now, I repeat my words. If there is any confusion, sum of all cash flows minus depreciation. Simple as that, total profits. Average annual profits. This divided by number of year. Total profit divided by number of year, 4. Average investment. Initial investment plus scrap value. Divided by 2. So ARR equal to average annual profit divided by scrap value, and simple convert it in percentage from here. Students, listen please. One thing, let me tell you. Sometime it may happen. You may think that Mr. Hamzah has done this calculation, applied the formula very quickly. Sometime it may happen. Please don't hesitate to ask me to show the formula. Again. Is it clear what I said now? Don't hesitate. Sometimes students, they say, sir, and they say at a later stage, sir, actually you are a bit quick. I say, tell me at that spot where I was quick. Because sometimes I don't realize that I went a bit quick. You know, I'm going with the flow. So should I repeat it or it is clear? Tell me. Good. All right. All right. Now, next, students. Now, what is the decision criteria? If ARR is greater than target ARR of the company. Who decide target ARR? Normally board. Then accept the project. Otherwise reject. Otherwise reject the project. Now, the next point. Now, the next point. Students, advantages and disadvantages of the method. ARR, advantages. Number 1, it is simple to calculate and calculate. Yes. Decision criteria is easy to follow for business manager. Means those who don't have finance background, even they can follow it easily. They can follow it easily. Profits based technique. So data is readily available. Readily available. What are the drawbacks? Yes. Profits are subject to manipulation. By management. They can manipulate it by non-cash items. They are subject to manipulation. They can manipulate profit. And hence, next point. It ignores time value of money. Sorry. Here we are. It ignores time value of money. Yes. It considers, we are calculating average of all profits. Means tomorrow's profit, $1, it has same value that of today's. Which is incorrect. Which is incorrect. It is a relative term and ignores the size of project. Note it down, I'll explain. Now, students, just see here, project A and project B. They have ARR 40%, sorry, 40% and 18%. Now, based on ARR, which one should be selected? A. That is preferable, quite logical. Is it or not? But it is not telling us how much investment is there, how much profit is there. It is not telling anything else. So it ignores the size of the project. For example, their investment is only 5 million and here 50 billion now. So this ARR is not telling us about that. Now, average profit used in ARR may not be profit in any single year. Note it down. I will show you. Let me show you. You see, we used average annual profit here. It is not a profit earned in any single year. Here for 350, 430, 57. What we are using? Average profit. So again, a drawback. Yes. So student, ARR, accounting rate of return, is done. Now, let us proceed further. The next topic is, that is, have you noted it down? Everything? Tell me, please. Good. Now, because I'm going to delete it, resetting it. Yes. Now, just a minute, please. Now, the next topic is, that is, payback period method. So payback period method of investment appraisal. What is payback? Payback period of investment appraisal. Students, the first, sorry, payback, yes, period. The first preference of and the first concern of any investor in a business is that by which time my investment will be returned. By what time my investment will be returned? This is the first concern of each investor. And of course, it is an important concern. So payback period method, it tells the time period. What is payback period? The time period in which initial investment in the project will be recovered is called payback period of the project. The time period. So we need to calculate. Student, why we need to calculate? The one reason I told you, it is a concern. The second point is, I am going to invest 5 million in a project. I don't have money. I need to borrow from the bank. And bank is giving me for 5-year loan. Means in 5 years, I have to return the amount to the bank. Now, my first concern is that whether the project will return 5 million in 5 years or not. What is payback period of the project? If project is not giving back that amount, I cannot go ahead because I will not be able to return money to the bank. So now how to calculate payback period? So that's very easy. So I will write, remember all other techniques are cash flow based. Only one technique was profits based. So cash flows of the project, for example. Now, so initial investment, 1750, for example. That is 420. 478. 545. 590. And 321. 321. Yes. For example, these are the cash flows of the project. Now, how to calculate payback? We need to make another row, cumulative cash flow. Cumulative cash flow. Here it is negative. Cumulative means total to date. Total to date. Now, just see here. This is negative. This received. Positive. What is remaining? Remaining this. Now, this was negative. This received. This is remaining. Negative. This recovered. Now you see here. We need 307. How much there are? 590. It means that only a part of year 4 will be needed to recover this amount. I repeat my words. Only a part of year 4 will be needed to recover this remaining amount. So 3 year and just see here. Negative sign is the amount needed. So I say 307 divided by, sorry, this part. Yes. 0.52 of year 4. So 3.52 years is the payback period. I repeat. Cumulative to date. This received, remaining. This received, remaining. This received, remaining. Now we need this. Year 4 has this total cash flow. So 307 divided by year 4. So 0.52. So 3.520 is 3.52 is the payback period of this project. That the project will repay its investment in 3.52 years. Now, so we can convert into the months as well. For example, in months, this multiply in 1 year, there are 12 months. And you see here, 6 months. So 3 years and 6 months. And 6 months approximately. We simply multiplied fraction with the 12. Now, I hope this point is clear. Now, so payback period, we have learned payback period. So then it has this method, advantages and drawbacks as well. What are the advantages? Yes, it is cash flow based technique. So more sound. Second, it helps to reduce risk of business by recommending projects with shorter payback. Yes, that you accept a project which has shorter payback. Now, students, but it has some drawbacks as well. Very critical drawbacks. Very critical drawbacks it has. Now, drawbacks. First is the same, it ignores time value of money. Time value of money is ignored. The second point is it ignores the cash flows occurring after payback period. Cash flows occurring after payback period. What does it mean? Just see here. For example, this project A, this B, both have investment 1,000, 1,000. And their cash flows are like that. For example, 500, 300, 200, 400, and 350, 350. Both have payback period of 3 years. But from year 4 onward, for example, it has cash flows 420, 500. It has cash flows 280. Now, based on cash flows, payback period, sorry, both are okay. But what is, both have 3-year payback period. But what is happening after year 3, payback period is not talking about that. I mean, it does not consider full life of the project. Means that it does not consider full life of the project. Means what is happening after payback period, it is ignoring that. And the last, there might be other points, but I am discussing the most critical points. Payback period method, it encourages investment in short-term projects. And hence, business may lose its long-term focus. Business may lose when you say accept the project with the short-term life. So sometimes projects are long-term for the business, which are important. They ignore that. Now, let us proceed further. Student, is it clear to everyone? Any confusion, any problem? Do let me know, please. Is it clear so far? Tell me. Good. Now, students, so payback period is also done. The next, we have to learn the concept of time value of money. What is time value of money? What is time value of money? That today's money has more value than tomorrow's. Yes. Today's money has more value than tomorrow's. Because of three reasons. Because of three reasons. Number one, inflation. Inflation. Money will be devalued. If you get 1,000 rupees today, and you say, after 1 year, the value will be reduced because of inflation. The second, opportunity for investment. If you are given 1,000 rupees today, you can invest and make it double by tomorrow. But if you are getting it tomorrow, that will be 1,000 only. The third is risk or uncertainty. That it is clear that you are getting money today. But will you get it tomorrow? Which is being promised? Not clear. Not clear at all. I hope this point is clear to you people. Is it clear? Time value of money. So when I started with the investment appraisal techniques, and I told you discounting techniques and non-discounting. So discounting techniques consider time value of money. And non-discounting, we have done two techniques. They do not consider time value of money. Now, next point. So then the concept of discounting and compounding. Come here. I need to make you understand that. For example, so the concept of discounting and compounding. if you have $100 today and you go to the bank, you deposit it with the bank at 10% rate, what you will get? 100 into 10%. You will get this interest after 1 year. And the amount will become this. You invest this today, you will get interest. Yes. You have one option that you draw 10% interest today. But again, you reinvest. Next year, again, you reinvest this amount, total 100, 110. Now you will get interest on 110. No interest, you will get next year, you will get interest on 110. And the total amount will become 121. So compounding and discounting means that you are not withdrawing interest. Rather, you are in reinvesting the interest as well. This is compounding and discounting. Assumption means that cash flows earned are reinvested at given rate. This is assumption of discounting and compounding. Now, so students, let us learn one more thing from this. Just see here. Now, so students, just see here. This is 100 and this is second amount. If we take 100 common, math rule, 1 plus 10%. 1 plus 10%. 10% equal to 110 equal. Is it clear to you people? Is it clear what I have done? Is it clear? Simple mathematics common I have taken. Is it clear? Yes or no? Now, thank you. So students, just see here. This is 100 you are investing today. Present value. Amount you are investing today. 1. This is the rate you are investing at. R. And this is the amount you will get in 1 year time. Future value. Future value. So present value is equal to, rearranging the formula, future value divided by 1 plus R. So present value is equal to, I'm just making you understand the formula. 1 plus r raised to power minus 1. And if it is for 1 year, its power is 1. And if it is for n year, raised to power minus n. So we have derived a formula. Although in exam you need not to derive, but you should know how it works. Now, so students, this 1 plus r raised to power minus n, it converts future value into present value. This is called, 1 plus r raised to power minus n. This is called discount factor. Discount table is given in your exam, but we need not to memorize that. Now, students, we will take a short break, 5 to 6 minutes. Then we will be back and we will continue. Okay, so take a short break. Yes, everyone. Now, so students, the next topic we have to study, that is discounted payback period method. In the payback period method, we discussed a drawback that it ignores time value of money. So there came discounted payback. Payback. This is the next method. And this is quite easy. Similarly, we will write cash flows of the project. Let me copy the same cash flows. Yes. These are the cash flows of the project. Sorry. Yes. So I will just change it for good a bit. 821, make it. For example, discount rate or cost of capital is 8%. What we do in discounted payback, we calculate present value of all cash flows first. So present value is equal to at the rate of 8%. Now you see here, everyone, focus everyone. One way is we go to discount table, find that it is given here, discount formula sheet. But that will take too much time. We need not to waste time. Simple is that. We know that future value, cash flow, multiplied by 1 plus R, 8%, raised to power minus this. We have linked it to the here. Now, so students, here it is. We do this and we get answer. Cash flow, we have applied the same formula, future value into 1 plus R raised to power minus N. You see, N number of years. Simply drag it. And you see here, yes. Simply round off. Is it clear so far? Tell me, is it clear or should I re-explain? Tell me frankly. Now, students, cumulative cash flow column equal to, no, now we have to make that from this here, next year, this negative, this received, this negative, this received. So again, we have to do it rounding off. Yes. Equal to this negative, this received. So you see here, this negative, this received. Now, 4-year complete, discounted payback. And part of year 5, how much part? 85 divided by this. Yes, 4.15 year. Discounted payback has also all the same drawbacks and advantages. All the drawbacks and advantages as that of discounted payback, as that of simple payback. Only one drawback is removed. Time value of money. It considers time value of money. Now, the next topic. Still there is a drawback, which still there. It does not consider time and value of money. It does not consider this. These drawbacks have not been removed. For that, it comes the concept of duration. Duration is our last topic for today. It is a first class, trial class, majority of you here for that. But in the next class, we will be studying full 3 hours from the next week. So duration I will cover. What is duration? It is the weighted average time to recover the cash flows from the project. Means weighted average time to recover the cash flows from the project. Now, so weighted average time, just see here. 0, 1, 2, 3, 4. Let me solve it for you. How to calculate duration? Just see here, everyone. What we do, we ignore investment phase. We start from cash inflows. For example, that is 420, 470, 250, 230. Rate of return is 10%. Now, how to calculate duration? For example, whatever is the investment, remember we talk about cash flows. What we do, we calculate present value first of all at the rate of 10%. Future value into 1.1 raised to power minus this. Yes. Now, simple is that. So we calculated, so step 1, calculate present value of cash flows. Yes. Now total present value has to be calculated, equal to sum of all. Sum of the present values. Now just see here, please focus everyone. Weighted average. How to calculate? Focus. Equal to present value divided by total present value. Multiplied by number of year. Okay, let us do in 2 steps. First of all, do this. Only divide for your better understanding. This divided by this, weighted average. This divided by this. Yes, weighted average. Equal to this divided by this. Now, weighted average. Now multiply each amount with relevant number of year. In exam, you don't have to write these narrations. You simply solve. I'm writing this present value and this just to show you people what is going on. This multiplied by relevant number of year. Simply this multiplied by this and we drag it, it will automatically solve. Means now this has been multiplied by this here. This has been multiplied by this here and so on. Now this is duration of the project. Sum of all that. Note it down, then I'll explain once again. Students, I repeat, we calculate present value for each year, calculate total present value, calculate weighted average. Means this divided by this each year, divided by total. And multiply with number of year and the sum of all. This is the duration of the project. Now, how to interpret duration? We said it is the weighted average time to recover the cash flow from the project. How to interpret it? If duration is more than half of the life of the project, it means majority of cash flows are in later years of the project. students, you see it is around near the half, not much more than. Means if it is 2.89, then you see its majority cash flows are in the earlier year. So it is around near the half. Duration is near the half of the life of the project. Okay, now, so I will give you a question to solve for duration because it is important topic from exam point of view. Yes. So cost of capital R is 8%. Please calculate duration. Be quick, everyone. Give me the answer. Be quick, please. Okay, let me solve it for you people. Present value at the rate of 8%. This multiply 1.08 raised to power minus. Here we are. Oh, sorry. Yes. Now, total present value equal to sum from here to here. Now, so weighted average equal to this divided by this multiplied by this equal to this divided by this multiplied by this. This equal to this divided by this multiplied by this equal to this divided by this multiplied by this. Now, so sum of all that. So I have merged two steps, you see. 2.52, your answer is right. 2.52, your answer is correct. Now, so students, we see this duration is less than half of the life of the project. Half of life is 2. You see, around same. So cash flows, majority of the cash flows are in the earlier year of the project. Is it clear? Okay, students. Now, so duration, you know that considered time value of money, cash flow based, covers the full life of the project. Only one drawback. It is difficult to understand. Only one drawback. So students, that's it for today. We have done the target for today, which I told you the agenda at the start here. So we have done all that you see here. So in the next class, what we will be doing? In the next class, we will be doing NPV, IRR, MIRR, and then we will be talking about NPV if we have time. Of course, we will be having NPV with inflation and taxation. So this is the target for the next class. Yes, to the all enrolled students, most probably it will be sent by email. Okay, notes. Please, those who have not enrolled, kindly, this is the WhatsApp number. Contact here and get enrolled before next class. Thank you. Thank you. Take care. Goodbye.
Bye.
Goodbye. Goodbye.